Dan Deming of KKM Financial joins us now as we start a fresh trading month. Here we are, ready for some March Madness.
We are ready for March Madness, both
more
in
than
the
one
markets
way.
and in the basketball arena. Exactly.
A nice February, though. We saw some gains during that month.
We did, yeah. Most of the major averages tacked on some significant gains. Really, when you look at how well they performed in January, they were both. All the major averages are up better than 3% for the month of February as well, Angie. So, the fact that they were able to hold on to January's gains and build on it, I think, is a positive for the market.
What index was the top performer in February?
Well, right now, you'd have to say it was the Russell. I mean, the small caps outperformed. Now, I think, they were up about 5%, with the other major averages up anywhere between 3 to 3.5%. So, again, a little bit outperformance in the Russell. And you had a couple factors in play there. The dollar moderating a little bit helped out the smaller caps, but also just the growth prospects, and then we did get GDP yesterday as well, and that was a little bit better than what the market had anticipated. So that also probably, again, was one of those themes in the marketplace that helped hold the Russell up.
Dan, what will you look forward to in the new month of March?
Well, I think what we're going to be looking forward to is what we've been paying attention to, and you're just going to continue to pay attention to the Fed. I mean, the Fed is the driver of these markets. It has been the last couple of months. Now, can they continue to navigate the landscape? We need to see some growth prospects. So some of the numbers, unemployment coming out, later. One thing that they talked about in GDP was the strength of the labor market. And, if we do see any wage inflation, that might cause the Fed to change their tone a little bit, which would disrupt the equity markets.
Also, the VIX, and I know you've traded VIX for a while.
Yep.
You're a seasoned trader. Boy, when you start to see the VIX get down to these lower levels, what does it say?
Well, it increases the odds that it's going to move higher, and that's just the mean reversion factor that all markets experience. So it's just not unique to the VIX. But the one thing is, Angie, is that when you see the Fed put in the backstop that they have the last couple of months, that definitely reduces the probability of increased volatility. Now, it doesn't mean it can't happen, but the probability is decreased, and we've seen that. We've seen this market on any little selling pressure the last couple of months. The market has been able to bounce out of it very quickly. So once again, the realized volatility, meaning how much the market actually has moved in the last 10 or 30 days, is dramatically lower than it was a month ago, and the VIX is taking its cue from that as well.
Good to get your trader take. Thank you.
All right, thanks for having me.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.